Good morning and welcome to World Acceptance Corporation's first quarter fiscal 2027 earnings conference call. This call is being recorded. At this time, all participants have been placed in a listen-only mode. Before we begin, the corporation has requested that I make the following statement. The comments made during this conference call may contain certain forward-looking statements within the meaning of Section 21E of the Securities Exchange Act of 1934 that represent the corporation's expectations and beliefs concerning future events. Such forward-looking statements are about matters that are inherently subject to risks and uncertainties. Statements other than those of historical fact, as well as those identified by the words anticipate, estimate, intend, plan, expect, believe, may, will, and should, or any variation of the foregoing and similar expressions are forward-looking statements. Additional information regarding forward-looking statements and any factors that could cause actual results or performance to differ from the expectations expressed or implied in such forward-looking statements are included in the paragraph discussing forward-looking statements in today's earnings press release and in the Risk Factors section of the corporation's most recent Form 10-K for the fiscal year ended March 31, 2026, and subsequent reports filed with or furnished to the SEC from time to time. The corporation does not undertake any obligation to update any forward-looking statements it makes. At this time, it is my pleasure to turn the floor over to your host, John Calmes, Chief Financial and Chief Strategy Officer.
Thank you. Good morning, and thank you for joining our fiscal 2027 first quarter earnings call. Before turning to the numbers, I want to thank our team members across our company for the work they do every day serving our customers. The results we are reporting this quarter are a direct reflection of their execution and discipline. We are pleased with the first quarter results and, more importantly, believe we are well positioned for the remainder of fiscal 2027. This quarter reflects steady progress against our core priorities: growing the loan portfolio responsibly, improving credit quality, and maintaining a disciplined approach to expenses. We achieved adjusted earnings per share of $2.12 for the first quarter. Earnings benefited from a 4.8% increase in revenue, as well as a 13.4% decrease in provision expense. The revenue increase is due to continued year-over-year loan growth, as well as a 91 basis point increase in interest and insurance yields. Importantly, our credit quality continued to improve as well. Our annualized net charge-off rate decreased from 19.2% in the first quarter of last year to 18.2% in the current quarter. We also saw improvement in delinquency on both the front end and back end. Most notably, front end delinquency decreased from 19.2% to 18.1%. These trends reinforce our confidence in the health of the portfolio and the strength of our underwriting. Our expenses outside of one-time costs related to the CEO transition, we saw modest increases in our G&A expense, and we expect to maintain this disciplined approach to expenses going forward. At this time, Tobin Turner, our Chief Operating Officer, and I would like to open up to any questions you may have.
Thank you. We will now begin the question and answer session. To ask a question, you may press star then one on your telephone keypad. If you're using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then two. At this time, we will pause momentarily to assemble our roster. The first question comes from Kyle Joseph with Stephens. Please go ahead.
Hey, good morning. Thanks for taking my questions. Just wanted to get a sense for the kind of the timing in terms of the underwriting changes, when you guys tweaked them tighter, and at what point you kind of undid those changes.
Kyle, hey, thanks. Great question. This is Tobin. We really tightened our portfolio, the whole credit box, really about 6 months ago, kind of coinciding with the rise in gas prices. Thankfully, we've been pretty pleased with that's the way our portfolio is aged. Probably about a month ago, we started generally loosening a little bit, but I'd say we're still fairly conservative, and with gas prices continuing to spike a little bit, I like where we are. We're more open than we were 5 months ago, but we're still pretty conservative.
Got it. And then on the demand side, can you give us a sense for how things have trended, call it year to date? We had large tax refunds, but to your point, a lot higher gas prices, and just sort of any changes in demand you've observed?
Demand has been, thankfully, pretty robust for us. The bookable apps we've seen have kind of decreased a little bit in conjunction with our tightening of the credit box. But overall or systemically, we don't see a shrinking in demand. So we feel pretty comfortable with demand right now.
Great. That's it for me. Thanks for taking my questions.
Thank you. Again, if you have a question, please press star then 1. This concludes our question and answer session. I would like to turn the conference back over to John Calmes for any closing remarks.
Thanks, Drew, and thanks for joining our first quarter earnings call. We appreciate your interest.
The conference has now concluded. Thank you for attending today's presentation. You may now disconnect.